Hey everybody, Ashley Page here. Thank you so much for joining us on our educational blog today. For those of you all who are new to the educational blog, what we try to do with that is we try to do a deep dive on one topic that to add to your library of your knowledge, so to speak, that you may not have heard of, but we look at a lot here, and that's in compare and contrast to the Investors Insight blog that the portfolio guys do on Monday to give you a broader based look at what the market is doing this week. So we're thrilled you're with us, and we hope that this is something that sort of adds to your knowledge on money and markets. And our topic today is, what is a company's capital structure, and why is it particularly important to understand what it is right now? A company's capital structure is, simply put, if a company is out there selling a product or a service, it's like the old expression, it takes money to make money, correct? We've all heard that. Well, what a company has to do is it has to finance itself to be able to produce the product or service for you that it wants to produce. The capital structure is, when a company does that, it is a mix of stock or equity, stock that they sell to you, that you invest in the company, or it's debt, bonds, borrowing from a commercial bank at an interest rate component. So companies have different capital structures. Most companies have a mix between the two. They've got a certain amount of stock they finance themselves with, certain amount of debt, and there's both an art and science to sort of balancing that off in what is best and to meet a company's long-term mission. The interesting thing about a capital structure is that they are as different as companies are different. I'll give you a good example of that. On the one hand, if you've got an IT company that's, say, heavy in intellectual capital, heavy in people programming, things like that, sell a software product or service, whatever they do. If you have a company like that on the one hand, if you look on the other hand, say an automotive manufacturer to accomplish their mission and sell you the car, they've got to have large plants, they have to have a lot of equipment, they have to have supply chains. As you can see, those companies and their mission would be very different. So the way those companies are going to finance themselves within the capital structure as a mix of debt and equity is going to be different. What is common about all companies, though, is that you are trying to get the ideal, or what we would call the optimal mix between the two. Certain amount of stock, certain amount of debt. And you're like, well, why do you do that? What you're trying to do is you're trying to minimize the cost of financing yourself without taking away from the long-term value of your company and what you're trying to do. So one definition that we look at here among the portfolio team when we're looking at the companies that we invest in for you, one thing among many we will look at in our technical analysis is what kind of capital structure they have, how much stock they have, how much debt that they have. And there's a term that we use that is common out there that you may not know, called the weighted average cost of capital. Weighted average cost of capital, or it is abbreviated by WACC for short. What the weighted average cost of capital is, you've got a certain amount of cost, issuing cost on stock, for example. You've got a certain amount of cost to finance yourself with stock. You've got a certain amount of cost, usually the interest rate on a bond or long-term debt, you've got costs there. So what chief financial officers, among other roles that they have, will often do is that they will try to get the ideal mix between stock and debt to finance themselves, again, to keep that cost as low as they can, but not take away from the market value of their company long term. The reason we look at that a lot right now is, think about this for a minute. It's like your own household. You finance yourself with savings you have in the bank, or maybe something that you've borrowed, like a mortgage. Same companies do the same thing on a different scale. So you're looking at the cost mix of that. If you can do many times something more with savings, is cheaper than borrowing money to do it. Companies do the same thing and look at that. Again, you've got a certain amount to issue stock and cost, you've got a certain interest rate. The reason that's so important right now is what's happening, of course. Interest rates are going up. So one thing that we're looking at in a lot of these companies right now is, let's say, if they have a high level of debt that is adjustable rate, not fixed rate, but adjustable rate. So if they've got a good bit of adjustable rate right now, what's going to happen? As interest rates move up, their cost to operate gets higher, having nothing to do with the product that they sell. So one thing that we're always doing on the portfolio team is looking at a company's capital structure to see if they're running really efficiently and what the interest rate environment is. So that's what a capital structure is. That's why it's important. I will say, in addition to the cost of the debt, if it's rising, we always like to look at, you'll see companies many times, they've got a lot of adjustable rate debt. What they'll do is they'll do what call refinance it, almost like you would your home mortgage, and they'll refinance it to a lower rate at fixed rate so they don't have that risk. So you've got a lot of companies probably right now looking at what their adjustable rate, interest rate on the debt portion is that's going up, trying to redo that where their costs are more stable. We also look at what we call the overall leverage of a company. And that is, do they have a lot of debt versus stock? Many times, if a company is highly leveraged like that, it can be a little bit of a problem. So those are some of the things that we are looking at within a company's capital structure to see how strong their market value is going forward, but what the cost component is on the capital structure. So as always, if you have any questions about this or any other topic, feel free to reach out to us by way of any social media platform. And we love to do it the old-fashioned way. We love it when you just call us on the phone, or, we're Southerners, so we love this. We love it when you just come by to see us. So we appreciate all of your interest in Five Plan Partners and what we do here. Hope you have a great rest of the week, and thanks.